Welcome back. We are diving deep today into what should be the cornerstone of every single financial plan out there, the emergency fund.
Mm.
And this isn't just about, shuffling money around from one account to another. This deep dive is really about transforming that constant anxiety, that what if feeling, into genuine financial resilience.
It's about building a buffer.
Exactly, a buffer for when life inevitably throws a curveball at you.
It's the ultimate financial insurance policy, really. And when we talk about an emergency fund or an EF, what we're defining is a critical safety net. It's a dedicated stash of cash set aside for one thing and one thing only.
And that's unexpected expenses.
Unexpected and unavoidable expenses.
Yeah.
This money has a very specific job.
Okay, so we hear unexpected all the time, but let's make that really concrete. What are the high stakes, real world examples that justify building this whole thing in the first place?
We're talking about truly urgent situations, a sudden, pretty significant medical bill, for example.
Right.
Or a surprise car repair that, makes your vehicle unsafe to drive. You can't get to work.
Oh.
Things like replacing a furnace in the middle of winter, fixing a leaky roof. Or, this is the big one,
Worst one.
covering your essential living costs if you suddenly lose your job.
And I think it's just as important to set boundaries. What is this money not for? I think a lot of us are prone to that little emotional shopping impulse.
It is definitely not for lifestyle creep. So,
No.
it isn't for routine expenses. It's not for the new phone or for that spontaneous trip you want to take.
So my daily fancy coffee habit doesn't count.
That's a budgeting issue, not an emergency. This fund gives you that peace of mind because it's serious money and it's reserved for serious, unexpected situations.
Why is this so imperative, though? I mean, a lot of people think I've got good credit. I'll just, throw it on a card if a real emergency happens. Why is that mindset so dangerous?
Because that high-interest safety net, it often becomes a financial trap. An emergency fund gives you resilience. It stops a small, manageable event, let's say a $500 car repair, from forcing you to pull out a credit card with like a 28% APR or a high-interest personal loan. That debt just compounds so quickly, it turns a temporary shock into a long-term setback.
One that can take years to get out of.
Exactly.
Years.
And the data on this, it really shows just how exposed the average person is without this kind of buffer.
Oh, it's truly eye-opening. The U.S. Federal Reserve found that 37% of American adults couldn't cover a $400 emergency with cash or, its equivalent.
$400.
Wow. Think about that. Almost 2 out of every 5 adults would immediately face debt or some kind of distress over an expense that small. That statistic, it underscores why building this fund is a national priority, not just a personal one. Okay, so let's unpack this. If that's the risk we're all trying to mitigate, then our mission here is to lay out a clear and, more importantly, an achievable strategy. Not just for building the fund, but for doing it fast.
And that starts with the goal, the big question. How much is enough? We're all kind of familiar with the standard guideline.
Right, introduce the standard, but I do want to challenge it a little later. What's the general rule of thumb that experts usually cite?
The standard is the 3 to 6 month rule. Financial experts pretty much universally suggest saving enough to cover 3 to 6 months of your essential living expenses.
And we have to define essential.
Yes. We're talking about the absolute non-negotiables. Your housing, so rent or mortgage, utilities, groceries, necessary transportation to get to work,
Yeah.
and your minimum debt payments.
Basically anything that keeps you housed, fed, and safe.
That's it.
But, for a listener who's just starting out, or maybe someone who's climbing out of debt, aiming for 6 months of expenses, that can feel completely paralyzing. It can feel impossible.
And that's why we always emphasize momentum over perfection. If the 3 to 6 month goal feels like climbing Everest, then start smaller. Start with a psychological goal that's highly achievable.
Like what?
Getting to your first $100.
Yeah.
Or $500. Or especially that first $1,000 mark. Reaching $1,000 is transformative.
Yeah.
It means you're no longer in that 37% who panic over a minor repair.
Right. You get a little breathing room.
You do. And that sense of accomplishment, it fuels consistency. And consistency is so much more important than speed.
I really appreciate that focus on momentum. But, should we be challenging that 3 to 6 month rule in today's economy? If you have, say, a family of 4 and you own your own business, 3 months feels wildly insufficient.
You're absolutely right to question it. The ideal target has to be tailored to your personal risk. If you have dependents, if your income is commission-based or just unstable, or if you have low job security.
Or work in a really specialized field.
Yes. then your target should be higher, maybe 9 to 12 months, easily. You have to factor in that volatility.
And beyond just job stability, we should probably look at the broader savings landscape. What's the current context?
Well, we're seeing a bit of a paradox. On one hand, approximately 54% of U.S. adults do have 3 months' worth of expenses saved, which is great.
Okay, that's better than I thought.
It is.
Huh.
But if you look at the speed of saving, the personal saving rate in February 2025 was 4.6%.
4.6%.
And that is significantly lower than the long-term historical average. So what that tells us is that while many people have a cushion, many more are struggling to replenish it or build new wealth. It suggests a real widespread need to refocus on strategic saving.
That 4.6% figure is so crucial because if people aren't saving much of their income, they need a clear, actionable strategy to, accelerate the process.
So let's get into that. Let's transition to the actual methods for building this fund fast.
Method one is what we call a comprehensive financial assessment, but we need to go a bit deeper than just, looking at receipts. I recommend reviewing 30 to 60 days of your earnings and your expenses. Use an app, spreadsheet, whatever works for you. And the goal isn't just to see where the money went, right? It's about differentiating what you call essential needs from discretionary wants.
Exactly. But let's add another layer to that. Differentiate between essential needs and what I call the absolute bare minimum expenses.
What's the difference?
Your 6-month goal is based on your essential needs. But during a true crisis, like a job loss, you're going to cut even deeper.
Got it.
Knowing your absolute bare minimum number, that rock bottom figure you need to survive, that gives you a secondary critical level of confidence. So go through your statements and be aggressive with your categories.
That clarity really helps with method two, which is setting achievable goals. We all know the save 10% rule, but how do we make that actually stick when the final goal feels so far away?
You have to break the psychological barrier. So if your goal is, say, $10,000, that feels huge, but that's just 400 separate payments of $25. Focusing on just putting away $25 from your next paycheck feels totally manageable. We call it chunking, breaking that big goal into small, frequent, and rewarding milestones. If 10% is too much right now, start with 2.5% or 5%. Just be consistent.
And consistency is best achieved through method three, automation. This, to me, is the cornerstone. Explain the pay yourself first method.
This is the most powerful behavioral trick there is.
Yeah.
Because you remove willpower from the equation completely.
Right.
You set up recurring, automatic transfers from your checking account to your dedicated savings account, and you schedule it for the day after your paycheck lands.
Or even better.
Even better, if your employer offers it, use direct deposit splitting. A portion of your income goes straight to savings before you even see it hit your main checking account.
The theory being you can't spend what you don't even know you had.
Precisely. It turns saving into a passive habit instead of an active chore. But a quick, crucial side note here. While you're setting up this automation, make sure you set up balance alerts on your checking account. This is just to prevent any accidental overdraft fees while you're kind of getting used to living on that smaller checking balance.
Good tip. And finally, method four, leveraging windfalls. This is where so many people stumble because unexpected money feels like permission to spend. How do we fight that immediate psychological urge to splurge a tax refund or a bonus?
You have to have a plan before the money arrives. If you're budgeting tight, a windfall is your greatest asset for this. We recommend what we call the 80-20 rule.
80-20.
Direct 80% of it immediately, automatically to your emergency fund, and then allow yourself to use the other 20% for a want. This acknowledges that psychological desire for a reward, but it protects the majority of the gain. Resisting that urge to fund lifestyle creep is paramount here.
Okay, so we know how to save it. Now, where do we keep this critical pile of money? It needs to be, liquid, safe, and maybe just slightly inconvenient to access.
Storage optimization is absolutely essential. The fund has to be in its own dedicated, separate account. And we prioritize high-yield savings accounts, or HYSAs.
Why an HYSA specifically? So many people still just use a traditional savings account at their bank that yields almost nothing. Why is the yield so much better?
HYSAs generally leverage an online-only business model. They have lower overhead, no expensive branches, no tellers, and they can pass those cost savings back to you as a more competitive interest rate.
So even though this isn't an investment, that higher rate helps.
It helps combat inflation and keeps the fund growing passively, even if it's just a little bit.
What's the number one safety check every listener must do before opening one?
Always, without any exception, you must verify that the institution is FDIC insured for banks or NCUA insured for credit unions. This is the government guarantee. It protects your deposits up to the legal limit. Don't chase a slightly higher yield at an uninsured institution. Security is priority number one for this fund.
And you mentioned some banks are actually starting to incentivize this.
Yeah, we're seeing more financial institutions creating these kinds of loyalty programs. For instance, some banks offer tiered savings products that will give you an interest rate bump when you pair your savings account with, say, a checking account or other tools they offer. It's worth looking for those incentives.
We should probably touch on the other options just to rule them out, like keeping cash under the mattress.
Right. Storing a large amount of cash at home carries huge risks of loss, theft, or damage, and it earns nothing. Prepaid cards are also generally unsuitable for an emergency fund because of potential fees and the lack of interest. You need this fund to be liquid and secured by federal insurance, period.
All right, so let's assume the fund is built. It's secured in a competitive HYSA. How do we define a true emergency that justifies dipping into it versus something that's just, expensive or inconvenient?
You need defined, written guidelines for yourself. A true emergency is an event that is unexpected, necessary for your safety or livelihood, and unavoidable.
So an unexpected medical bill.
Yes. Urgent, safety-related car repairs, sudden home damage that isn't budgeted for, or an income disruption. Distinguishing these qualifying events from just wanting a nicer vacation is the key to maintaining the integrity of your safety net.
And if an emergency does hit, should we ever hesitate to use the money? Is there a risk of cash drag or something like that?
Absolutely not. Do not hesitate. The entire purpose of this fund is to be used. Using it promptly means you avoid accruing that high-interest debt we talked about, which is far more expensive than any cash drag from keeping money liquid. Remember, your EF is not an investment portfolio. It's a volatility buffer.
So what's the recovery plan? You might have just wiped out 3 months' worth of savings to cover a crisis.
The replenishment plan has to be immediate, and it has to be aggressive. Think of it like refilling your gas tank right after a long, critical trip. You revert to all your previous accelerated strategies, turn the automation back on, track spending intensely, and channel every single windfall straight back into the EF until it's full again.
Get back to a 100% capacity as fast as possible.
As fast as you can. That's the goal.
This brings up a really important question. Does this strategy fundamentally change depending on where you are in your life?
The foundation consistency, liquidity, that stays the same. But the risks you're protecting against change dramatically. For young professionals, for example, starting early is critical, even with just $25 or $50 a paycheck.
The focus is on the habit.
It's on establishing the habit and avoiding early career high-interest debt. That's the biggest destroyer of future wealth. I'd say, utilize those banking apps with automatic roundups to build passive savings momentum.
Okay, but for families, the stakes are just higher.
They are. The data confirms it. 45% of parents used their emergency funds in the past year, compared to just 34% of non-parents. That higher usage rate means they should be aiming for the higher end of the guideline, 6-12 months of expenses.
So for them, we need more creative budgeting than just cook more at home.
We need deep tactical savings. Look beyond just groceries. Analyze your insurance policies to see if you can consolidate and save. Review high childcare costs for shared services. Identify utility usage patterns for dramatic reductions. The goal is to rapidly free up significant capital to bolster security against family-specific risks.
And finally, what about retirees? They often have substantial investment portfolios. Why do they still need to keep a separate liquid emergency fund instead of just relying on their brokerage account?
This is so crucial. It's about something called sequence of returns risk. Retirees need that separate liquid EF to cover an unexpected medical bill or a major home repair without being forced to sell assets during a market downturn.
Because selling stocks when the market is low just locks in your losses.
Exactly. The EF protects the long-term integrity of their entire investment portfolio. They should be reviewing and adjusting this fund annually, too, to align with their changing health needs and the current cost of their essential expenses.
So when we put this all together, what does it all mean? The ultimate insight here seems to be that preparedness doesn't eliminate risk, but it completely transforms the impact of that risk. It can turn a financial crisis from a debilitating obstacle into just a manageable inconvenience.
And the key takeaway is behavioral consistency. Saving a small, consistent amount automatically is far superior to trying to save a large, inconsistent amount through sheer willpower. And remember, your financial plan is a living document. It's not set in stone. It requires regular assessment and adjustment because the world is constantly changing.
So I really encourage you to take one concrete action today. If you already have a fund, go check the interest rate on it. If you don't have one, just set up the first automatic transfer for $25. Future, you will look back on this moment as the foundation of your security.
And if we connect this to the bigger picture, here's a final thought. If you set your original emergency fund goal 18 months ago, have you reviewed the current cost of your essential expenses? Things like housing, utilities, groceries. Have you made sure your safety net hasn't actually shrunk in real terms? Inflation means that a 6-month fund calculated in 2023 might only cover 5 months' expenses today. Your safety net has to be regularly assessed and potentially raised to retain its protective value. That's the real assignment.